Hello again, and welcome to another of Mosaic's Coffee Breaks. Mosaic is, of course, a collaboration of the organisations shown at the front of this presentation, and that collaboration focuses very much on the ownership issues associated with mid-market law firms. And when we say ownership, we mean everything associated with ownership, mergers and acquisitions, partnership structures, succession planning, partner exits, and everything associated with all of those issues. I hope you enjoy this broadcast.
Hello, everyone, and welcome to the latest Mosaic Coffee Break, where we're joined for a second time by banking industry expert Paul McCluskey. Welcome, Paul.
Hello.
Thank you for joining us again. So it's hello from everybody at the Mosaic team. And for this particular coffee break recording, we're going to talk to Paul about client account interest, a subject that was barely mentioned for about 15 years, but found its way back on the agenda for all of our client firms when interest rates started being hiked by the Bank of England. Paul, do you want to start by giving us a bit of history on what happened and how it impacted the way that you've been advising law firms?
Yeah, no, absolutely. So I've been helping law firms with client interest for best part of 17 or 18 years. Started with Bank of Scotland when I looked after a portfolio in Scotland, moved down to England to take on the Lloyds Bank offering nationally. But at that point, even you go back 16 years, it was still law firms who would traditionally bank with one of the big four banks, but they would have designated accounts at that time, and they would be looking for something better for their clients. Then outcomes-focused regulation came into play, didn't it, which killed designated accounts. Law firms started to hold funds within their general client accounts and realised they could make a spread on the deposits, so they could retain part of the interest for themselves. And that worked really well for a period of time until 2008, when the banking crash kind of kicked in and rates just died after that. And for a long period of time, as you've rightly said, interest rates were awful and still are. The high street banks just now, the big four high street banks, underserve the legal sector dramatically. There's banks out there that will still provide a great offering, but I'll give an example. If you had £5 million available within your general client account and you placed that with Barclays, that would pay you £83,000 for the year. Placed it with HSBC, it would pay you 98,000. Placed it with Lloyds, it'd pay you 96,000. And pay it with NatWest, it'd pay you 85,500. Would it shock you to know that you could generate 250,000 off that quite easily? So that's an extra £167,000 that the banks are holding back from their law firm clients. £167,000 is equivalent to 10 fee earners. So according to the LMS financial benchmarking survey, the super profit on any fee earner is roughly about £16,000 for a full year. So 167,000 is 10 staff swinging on a chair for an entire year, and that's what's being held back from law firms. So you don't even at those differentials, you don't need to have huge amounts of money now in order to generate more income than the best fee earner would within that bank. So it's a huge opportunity for law firms to do it. Problem, I guess, is that so many firms now, they're either busy, inertia is a big issue for firms not doing it, or they're just not confident. They're just not confident about managing their client funds, and that's a big problem.
And picking that theme up, Paul, I mean, it's just like the numbers are just insane, aren't they? It feels like a no-brainer. But picking up that point you just made, kind of, if I'm a cashier particularly, and to an extent, if I'm a coffer, I will probably put this in a box mark. Oh, it's a bit too hard, isn't it? Now, I know, I think, some of the solutions to that, but Paul, perhaps you could help explain why it isn't anything like as hard as people think it might be, in terms of how you manage day-to-day transactions when you have got 2 or 3 different client accounts on the go.
Yeah, absolutely. And, the SRA do not limit the number of client accounts you can have. Clearly, they just want you to have the controls to reconcile the funds that sit within any of those particular accounts. So the secret is to place an amount of money within a secondary bank that you will never need to touch, a safe amount. So, if your client account never dips below £8 million, you could easily lift 5 million from that client account, place it with a secondary bank that would pay you an extra £167,000 a year for that same level of funds. And it takes no transactions to manage it because the funds will never move. Knowing that if it does, these are not funds that are tied up for 12 months. This is instant access prices that I've given you, these examples. And the good thing about that is if you think about number of service outages, TSB's system went down for near on a fortnight, didn't it? Lots of complaints a few years ago. Barclays' system is reputed to go over. You only have to Google bank service outages and it will show you. So I think it's a great thing if you're a conveyancing practice, for example, to have a secondary client account, so that if you had an issue with your primary bank account, could even be a fraud event on your client account where the SRA would expect you not to use that account till the hole in the account was sorted. It's really important to have a backup, a contingent banking facility. And that's what you can have by just structuring your client money properly. And we help firms do that. We give them a spreadsheet, and the spreadsheet just gathers the high and low balance points over the last 12-month period. That allows us to then figure out what is a safe level to place with a secondary bank, and then we can give them illustrations that would tell them how much additional income they could earn from it. They need to think about their interest policy, FSCS, the security of the funds, the bank they're choosing, all of these kind of good things. And hopefully, if a firm doesn't know how to assess the strength of a bank, we would help them do that. What I meant by hopefully is if they're talking to their bank, hopefully their bank would give them those kind of statistics that would help with their fiduciary duty to make sure that funds are safeguarded.
And Paul, presumably, without sort of giving a big sales pitch to you, presumably your role is to point law firms in the direction of which of the firms or which of the banks are providing the best interest rates, and you help them negotiate those best rates?
Exactly that, absolutely. So I have arrangements with the banks that do offer those higher prices. So where banks work on bespoke interest prices, so you could go to a particular bank, you could negotiate a deal, and you will never know whether that rate they've given you is the best rate that they have on offer. Where the arrangements I have with the banks, I know their price points, I know what rates they'll pay for different amounts of money, when that will change, and so on. And I can guide my clients guide them which bank to use. But also it needs to meet their service requirements as well, Howard. Some firms are happy to put funds in a 12-month breakable term deposit because it will still pay them 5.1%, which is incredible that you could get 5.1% as opposed to 1.9% that maybe some of the high street banks might be offering.
Are there minimum and maximum amounts that it's worth looking at from your point of view?
No, I think it needs to be what's worthwhile for the law firm, doesn't it? And would you place £1,000? Of course not. But when I'm talking about a contingent banking facility, that adds this different layer of requirement, doesn't it? It shouldn't just be about the money. It needs to be about what is right for the firm. Does having a separate contingent bank support the business continuity plan of the business? And if it does, sometimes the amount of money you place with that secondary bank won't matter because you'll have the peace of mind knowing that you've got a backup banking facility that will support your business.
Client account interest is once more our star fee earner, like they used to be 20 years ago. With opportunities like that in our sector, there always come challenges. So a lot of my client firms have been talking to me over the past 6 months about their interest policies in terms of what they pay out to clients. So are you covering that in the work you're doing with clients as well?
I do. I give them it's almost like a 10-page proposal, Nigel. It really supports it. So any law firm could go to any bank and try and cut a deal, but the relationship manager at that particular bank will not spend time with them talking to them about their interest policy, and I will. So I I think that any firm should they have their de minimis. So £50 is the going rate nowadays. But you would pay your client the same rate as if funds were held within a designated client account. Okay, and where that would be today, Barclays, on an amount less than £1 million, as most clients will have, Barclays 141, HSBC 195, Lloyds 131, NatWest 146. So that's the rates that they should peg their systems to pay their clients. That means it's fair and reasonable. They can advertise the link to their bank's rate. If the client asks, they get not a penny more, not a penny less than they otherwise would receive had funds been placed in a designated account in the client's own name. And that's the way it used to be. That's the way the SRA mandated that way back in 2011. And I think that's the fair way to manage it. The trick then is for the firm to cut a better deal with their bank above those prices, which creates that margin that they can retain for themselves.
You said, Paul, that to get a decent rate, you might have to go into the secondary bank sector. Does that pose risks of security, or is that something that, again, that's covered off?
There's a huge misunderstanding about FSCS. First and foremost, it's the individual's relationship with that banking license. So there's not one client account covered for 85,000 for the general client. It's lots of individual multiple 85,000s included within that general client. Then, of course, you have temporary balances. So each individual is covered for £1 million for the first 6 months before it trips back to the 85,000. So, but yeah, smaller banks would have a lesser credit rating. But let's not forget the day before Lehman's fell, they were A-rated. The day before Bank of Scotland fell, they were A-rated. NatWest were A-rated and are currently supported by the UK taxpayer at this moment in time. So the way it stands just now, my understanding, no one's lost any funds. If a law firm placed funds with a spurious bank that was high risk, then they'd be crazy to do that in the first place, wouldn't they? So I think it's only right that a law firm considers who are the bank they place their funds with, and that falls under their fiduciary duty to make sure that funds are safe. But if a bank fell, let's say that they're using one of the mainstream banks, and I wouldn't recommend that any firm uses, I don't know, either placing funds with State Bank of India, for example, where they will say that they will offer 7% on a 3-year bond, but it's non-breakable. It's that type of example that you would never place funds with. But if you're giving your client money to a bank, a UK registered bank that's FSCS protected, that offers the product to the legal sector, then in my view, they're all fine. Even Metro, Metro's been the bank that's gone through the bad press recently. And I still think that I don't really think there's much of a chance of them falling over. And if you were a law firm that held funds with Metro, then the insurance would still pay out if Metro fell over, unless, of course, there was prolonged bad press that spoke about the dangers of that bank, which at that point you'd be expected to move funds. But it takes you 6 weeks to open up a bank account with another bank, Mark. That's the problem. So if you had a contingent bank, a secondary bank account somewhere, you could move the money really quickly, which goes back to my first point about having a backup banking account.
Just coming back to your services, Paul, again, without it being the sales pitch, how do you charge for what you do? What do the law firms have to pay you?
So the way it works for me is I charge 10% of the net gain that they would receive. If they pay me in arrears. So the reason I do that is if their parent bank gets an act together and increases the rate that they pay, that reduces the additional income that they would receive, so they would pay me less. And I think that's fair to do it like that. This is money that they've never had, money they would never have known about, and so that's a charge that way.
Well said, Paul. Well said. Well, thank you everybody for all of your challenging questions. Paul for fielding them and telling us just what a difference it can make shopping around for a home for your client accounts. It's been great talking to you. Thank you again for joining us.